love the channel and find it useful in becoming a happy retiree. Subscribe today. Now, I want to get into some of the numbers behind this tax reform. I'm not going to talk about whether it's fair or not. I'm talking about where we're going. It's already here, and companies are getting a tax cut. And this can get a little murky when you look at the earnings perspective, but it's the lion's share of what drives your 401k plan has to do with earnings. That's the most straightforward way to explain this. We're always looking at earnings because it's the foundation of where markets trade. And I'm going to round some of these numbers here, but this is what you need to know about earnings, where we were and where we're headed. 2017, so last year, S&P 500 earned about $130. That's the profit for the group as collectively. In 2018, estimates, and this is without tax reform, were about $145. So that's a rise in earnings, just companies doing what they do. They continue to operate, grow. That has nothing to do with tax reform. Now, 2018, estimates are all of a sudden, everybody's scrambling to raise earnings estimates now that tax reform is law. And quite frankly, analysts they're finally getting back from vacation. No analyst wanted to bake in tax reform until it was actually law. And then they went on vacation, and then they came back late. All of a sudden, in this last week, you see your earnings estimates getting ratcheted up in a very rapid pace. Everyone's catching up. Tax reform adds a net, in this year, 2018, about $10 to earnings. You could argue it adds $20. It's a big, big number. So we're talking potentially significant numbers here. $20 on 145, where we thought we would be. That's another 15. That's a 15% rise from the rise we would have seen from just natural earnings appreciation. So from 2017, when earnings were 130, now could be 165. That's a 27% rise in earnings, not the stock market, but earnings. On top, that's again, we go all the way up to 165 on top of the $15 rise we would have seen in 2018 just from companies doing what they do and continuing to grow. The extra $20 comes from lower taxes, the 35% going down to 21, the new territorial tax system, along with several other smaller variables. But there's also a cost to corporations, and that's about a $10 cost due to the tax that now everybody has to pay, they're required to pay on their overseas cash. It's called deemed repatriation. Deemed repatriation. Basically money coming back from overseas. So the tax bill says, look, you S&P 500 companies, you have $2.6 trillion in overseas cash. You gotta pay taxes on that now. It's not a voluntary thing. You gotta do it. But it's a cost to companies. But it's only this big of a cost, which is the cost is about $10 this year. It's a giant number, $10 for the S&P 500 earnings, because it's effectively paying a backlog of taxes for years and years and years of profits that have been stacked up overseas. So we have economic growth and business in general moving forward that gets us from 130 where we were to 145. Then we have another $20 from tax reform that gets us to 165. We back out that one-time cost of the repatriation I just talked about, that's $10, and we're at 155 next year for earnings. That's a 19% year-over-year rise from last year. If you want to ignore the $10 because it's a one-time item, then you can make a solid argument that we're looking at $165 in earnings. You take where we are today on the S&P 500, about 2780, divide that by those earnings of 165, and now you look at a market that's trading at about 16.5 times forward earnings. Not exactly expensive. So you hear all this fodder back and forth, oh, the market's expensive. The market's at a high level. It doesn't mean it's in an expensive level, because earnings, which fundamentally allow markets to move higher, they have gone up significantly. So we're not really the market isn't where it is just on thin air. It has a foundation for where it trades today, and not overly expensive. It's definitely not cheap. I'm not saying that, but the fundamentals of what companies have been doing plus tax reform get us here in a fairly rational way. And again, this doesn't count the $120 billion worth of the tax cuts that are coming to families and individuals, part of what we talked about today. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.